Dorothy.
Current successful business will face a number of new costs with the expansion idea. Cost is a resource sacrificed or foregone to achieve a specific objective.
Dorothy.
We'll encounter new direct costs which are traceable to products and services. This will include the hiring of new glazier, the purchasing of the new equipment, etc.
Dorothy.
We'll also encounter new indirect costs which are not readily traceable to products and services. These are the depreciation costs of the equipment, petrol, rent, etc.
Dorothy.
We'll also pay extra product costs or the costs that are an integral part of a product or service with extra wood and the addition of glass, etc.
Dorothy.
We'll also pay higher period costs or the costs that are matched with the income of a specific time period, not part of the cost of a product or service. This will include the payment of wages.
Dorothy.
We'll also have to pay more fixed costs, a cost that remains constant despite changes in the volume of activity, which be such things as rent and business insurance.
Dorothy.
We'll also pay mixed costs, which are the costs that have both fixed and variable elements, which will include the specialty door orders and wages.
Dorothy.
Added variable costs include the payment of higher utility bills.
Dorothy.
Average costs relate to the cost per unit in terms of her resources to make the actual doors.
To determine whether the business expansion is feasible for,
Dorothy.
it is important to look at the number of variables. Firstly, contribution. The difference between selling price and variable costs. Contribution is the contribution made by the sale of a product service towards fixed costs and profit. Contribution is not the same as gross profit in financial accounting. To determine feasibility, it is recommended to look at the cost volume profit analysis. By calculating volume or dollar sales to break even or achieve target the profit, the study of the effects of changes in cost and volume on profits. Cost volume profits is important in implementing and management decisions, including pricing, product mix, and maximising the use of facilities.
The break-even formula is also necessary in the feasibility judgment. The formula to calculate the break-even point in units of product is fixed cost divided by a contribution margin per unit, where contribution margin per unit is the selling price minus the variable cost per unit.
Dorothy.
Doors sells her new glass doors for
$600.
each. The variable cost to produce the door is
$400.
each. Fixed costs incurred per year total.
$50,000.
Contribution margin equals selling price minus variable costs
$100.
minus
$400.
equals $300 per door. Break-even point in units equals fixed costs $50,000 minus the cost marginal per unit $300, which equals 167 doors.